first speaker. It's James Campbell of Botswana Diamonds, Johannesburg, South Africa. Financing of diamond projects. Where are the best opportunities for juniors? And there's a question mark after the juniors.
Thank you very much. Good afternoon, ladies and gentlemen. The stark reality of where we find ourselves now is there is a fraction of the level of junior diamond exploration than there was a dozen years ago. In Southern Africa, which produces a third of the world's diamonds, there are only 2 currently active publicly listed diamond explorers. I'm sure we all believe in the enduring value of the natural diamond, and that's after all why we're here today, and what it means and what it stands for. And clearly Southern Africa remains highly prospective. What I'm going to try to do in the next 20 or so minutes is describe the current situation and suggest what can be done to remedy it. If we look at the outline of my presentation, I'm going to briefly touch on global exploration trends because this is a very important context for the discussion itself. Diamond industry fundamentals, of which I'm going to give a very light touch because I've got eminently better qualified authors who are going to be speaking after me on that. How do you develop diamond projects? How do you fund them? Why Southern Africa? And then accessing exploration capital. So moving straight into global exploration trends. I'm not going to read through each slide laboriously because you've probably read it all by the time I've actually put it on the screen. There are a few important points I would like to draw from this slide. The first one is global exploration budgets remain below 2014 level and are still sitting at roughly half 2012 level. Australia and Canada are the highest areas of expenditure, but very importantly for us in the diamond industry, diamond exploration budgets for the first time have actually begun to increase. And this is a very difficult statement to find evidence for, but there does seem to be some roots of spring actually coming through. However, and there's always a however here, is that grassroots exploration continues to shrink. So where exploration money is tending to go at the moment is chiefly on mine site exploration or resource expansion, and then in brownfields immediately adjacent to it. So the out-of-the-box thinking and the innovation associated with finding truly new world-class deposits which would be associated with grassroots exploration is continuing to shrink. And that's not a very encouraging thing. So the diamond industry fundamentals. So how do we kind of translate the overall exploration funding scene into diamond industry fundamentals? Being in the industry, I firmly believe that the outlook is positive, particularly with the divergence between supply and demand. And very simply from a supply perspective, we see many of the older mines with the lower diamond price faltering and going into trouble. We see that there is very little diamond exploration activity going on at the moment, and there are no new world-class mines going into the future. And then we still see, despite the coronavirus and recent economic events, the gradual growth of the middle class in the Far East. And to bridge that gap, there has to be a real diamond price growth. From a pricing perspective, because that's after all what we put into our economic models when we start to look at different projects, is yes, there was a crisis or a structural shift, I'd like to call it, with the advent of synthetics on the horizon. But if you look at the precious stone industry and the pearl industry, they've all gone through that kind of event many years ago, and customers will buy what they would like to buy, so there will always be space for a natural diamond. Because after all, you won't want to start a relationship on the basis of something which is not natural, which is not ancient, which is not eternal. So, developing diamond projects. Developing diamond projects is a complex exercise, unlike many other minerals, because you have 3 variables to deal with. You have volume or size, you have grade, and you have value. So if you look at the left-hand side of this graphic, the kind of money you need to go discover a diamond deposit, particularly in Southern Africa, and these numbers refer to Southern Africa numbers, is in the order of thousands of dollars. And it's not too difficult to raise money for that particular area. But as you go from the left to the right, your confidence in your deposit and then your resource begins to increase, but it becomes more and more and more expensive, particularly when you need to realize 500 carats for an inferred resource and 5,000 carats for an indicated resource, because there's no shortcut about sending your gold to get assayed in a laboratory. You have to build a plant and you have to process the material itself. So how can you kind of differentiate yourself in this fairly standardized way? Well, there are a couple of things. Firstly, you can run some of these sequences in parallel rather than in sequence itself. And then secondly, and this is a really important point, particularly in our industry, is that deep expertise and technology are absolutely key differentiators. If you keep on doing what was done in the past, you'll keep on getting the same result. So you will see that many people are looking at, especially in the mining environment, going to autogenous milling, looking at X-ray tomography, and more advanced forms of liberation and concentration and recovery. But in the exploration space, it's been some time since we've had a paradigm shift in exploration technology to open up new areas for exploration. It's not just about the technical stuff, but in today's world, ESG is vitally important, but it has to take place within the context of a commercial return. And in this simple diagram, I've put the three major stakeholders, us as diamond explorers. We look at prospectivity, economic production, and security of tenure. The governments obviously look at revenue, job creation, beneficiation, sustainability, and investors, good governance, political stability, security of investment. And probably all of that can be wrapped up in that, the term I particularly like is about the social license to operate. And one might think this is just for miners, but it's very clearly for explorers too as well. There are also very onerous compliance requirements. Whether you're listed on the London Stock Exchange, the Toronto Stock Exchange, or the Australian Stock Exchange, that many people might think just because you're a junior, you do not have to make financial filings, technical filings, and all those kind of things. And having been in this end of the business, having been in diamonds for 35 years, but in the junior end for about 15 years, I've seen over that period of time, particularly on the London Stock Exchange, and particularly with England getting closer to Europe, that it's become more and more bureaucratic. So it's become more and more difficult in what was typically a venture capital exchange in the AIM market to becoming more normalized. So an AIM listing has become something like a standard listing on the main board. But hopefully, with Brexit, the British entrepreneurial spirit will begin to soar, and MiFID and those other related instruments will dissipate and allow it to become what is actually there to become, a venture capital exchange. So how do you fund exploration projects? Well, a lot depends on where you are in the resource pipeline. At the bottom left-hand side of this graph, you have entrepreneurs, private equity, and hedge funds who are willing to take a punt on a management team in a particular area. And then you go through what I call the orphan period, which is that period where once you've actually discovered a kimberlite, you now have to go through the hard yards of generating your resource until you get to the valuation stage, where you go through bankable feasibility study, and that's where the banks begin to start talking to you if you're lucky. But that intermediate area, which is generally an area for zones of acquisition and partnerships, particularly for juniors, because if you're a £5 million junior or thereabouts, to actually take a project from a deposit through to an inferred resource could easily cost you £5 million, and that's highly dilutive on shareholders. So that's probably the most challenging areas. And again, it's private equity, hedge funds, and in many companies, an initial public offering too. There is potential behind this, of course. People say, oh, why on earth am I going to invest in a junior company stock on the back of management who have a track record in a good area? And this is just a small case study. It's written up in a University of Botswana paper that the original shareholders in African Diamonds, and that was one of my previous companies, made a 25 times return on their investment if they sold out at the Lucara price peak. And there's a very interesting statement I'd just like to kind of highlight on this slide. And it's perhaps a provocative statement, but actually a very important statement, is that would AK6 be Karowe Mine today if it were not for the founding friends, family, and fools? And this is a statement taken from my chairman, Dr. John Teeling, because if you're investing in junior grassroots diamond exploration company, that great big long mouthful, you're probably going to be one of those three. And their friends will kind of die out over time as you lose money. Family hopefully will stick with you, and the fools will eventually make a return. But interestingly, there was a Sunday Times article in the UK that if you invested in a basket of John Teeling's companies, 162 group companies, which were by the very nature high-risk exploration, there was gold in Iran, for example, there was oil in the Caribbean, there was diamonds in Botswana, you would have outperformed the FTSE 100 index by 100%. So it just shows you that this kind of model around what I call business incubators, which I'm going to touch on a bit later, really does work. So what are the traditional sources of funding? This has become quite boring and almost become a little bit irrelevant in today's environment. Is that yes, there is equity financing, there's public equity, there's private equity, there is doing your roadshows to raise money. But typically what you find in the London environment, and I don't know too much about the Toronto environment, the minute you signal that you're going to be doing a fundraising, the market shorts your stock, picks up your stock then at a discount, you raise your money, the stock rebounds and they sell. So it's not like a game. But we all know how it actually works. So one becomes a bit cynical of following that kind of approach. Then, of course, there's debt funding, but that's typically when you're grown up and you've gone to the bankable feasibility study stage. So some of the alternative methods of funding which we're beginning to see come, and again, Canada's taking a lead in this area, and Britain's actually not too far behind. You've got royalty and stream arrangements, but that typically only starts to come into play once you've got your bankable feasibility study, so you have something to value and there's something in the ground. But then there's crowdfunding. Red Cloud is probably the best example sitting here in Canada, and Cornish Lithium in the UK has done some really good work around crowdfunding. And then there's cryptocurrencies and crypto tokens, but I've got to profess my ignorance on that side, but I see that the underlying product behind that is possibly even more complex than investing in diamond exploration. But it's something that is emerging, and one needs to take cognizance of that. A vital ingredient in the funding is to look at government incentivization, and you'll see this theme come through the remainder of my presentation. Canada, again, leads the way, and I'm not going to try and say that too much, but it really does, through its flow-through share scheme. And it's no surprise that Canada is home to the junior mining industry. You look at PDAC itself, 26,000 people, despite the coronavirus, and we all come here to learn and to network with each other. Australia is actually not too far behind on this, but the subtle difference between the Australian and the Canadian scheme, and you can look at the detail in this when you have a moment, is for the Australian scheme, it's very much for projects in Australia itself. Rather than Canadian listed companies, it's for companies which are listed in Canada. But Australia is fast catching up with a scheme they launched in 2018, and clearly they see an opportunity by providing tax incentives to individuals to invest in junior companies to grow their industry, and I'm sure it won't be too long before they take that to the next step and grow the global industry. Sadly, in South Africa, we did launch a scheme. It's called Section 12J of the South African Income Tax Act. It was modelled on the venture capital trust regime of the UK, but not one single investment has been made in an exploration or a junior company. So sadly, with all the great intention there was to begin with, it just hasn't worked. So why Southern Africa? Well, Southern Africa produces a third of the world's diamonds, and I'm sure that's, I'm sure we all know that, but it's very, very significant. It's also host to a major cratonic area, the Karpval and associated cratons. If you look at the graph on the right from Professor Mike DeWitt, you'll see the abundance of kimberlites in the area with Droneng, Cullinan, Venetia, and Arapa noted. So clearly it's a highly fertile area for kimberlite. And as I stated at the very beginning of this presentation, limited competition. There are only 2 companies who are publicly listed companies who are active in Southern Africa. If we look at that from an economic attractiveness presentation, you've got diamond prospectivity on the left-hand side and mining investment on the top. Canada clearly is, top right-hand corner is the best place to be because you've got the de-risked portion of both of them. But as you start moving upwards and you see clearly there Zimbabwe, South Africa and Botswana remain highly prospective areas for diamond exploration. Added onto that are the economics of this. You can't just go to an area that has got a great fiscal regime, security of tenure, and highly prospective. You've got to look at working costs. And what we did with this exercise here is we simulated a hypothetical junior diamond resource and tested against 5 Southern African fiscal regimes. And surprisingly for many, South Africa came out the top, comparing South Africa to Botswana, Zimbabwe, Eswatini, and Lesotho. And that's chiefly because it doesn't have the 10% royalty. A 10% royalty basically kills marginal or potential junior company projects. Just for reference, I haven't included a Canadian example here for the very reason in the bottom bullet on the left-hand side is that the operating cost environment in Canada is probably 3 times or more of that in Southern Africa. And I've used 2 Canadian listed companies' numbers for reference. Risk is also an absolutely vital thing, and this is taken from the Fraser study, and you'll see here that Botswana actually exceeds Canada from a policy perspective, and South Africa and Botswana are not too far and catching up with Canada from an investment attractiveness perspective. Limited competition. There are no diamond companies listed on the Johannesburg Stock Exchange. They are listed on the London Stock Exchange, the Toronto Stock Exchange, and the Australian Stock Exchange. And even if you did list on the Johannesburg Stock Exchange, you would be sadly find it really difficult to raise any form of exploration capital. So how does one access exploration capital, seeing that it's quite a tough environment? How do we survive? Well, firstly, we obviously look at the different markets we work in. TSX, the ASX, the LSX. We forget about the JSE because it's really not too much worth spending the time and the energy on that. And if I just quickly go into each of the different stock exchanges, firstly the TXX, this is host to more diamond companies than all the other stock exchanges put together. It's 32 diamond companies. If I haven't named you under the notable, my apologies, but there are so many, and this is just a little snapshot. Interestingly, if you look at the snapshots in the next 3 slides, it's the explorers who've been able to generate a positive shareholder return last year rather than the miners, but I'm sure that will switch around quite soon once the market turns. Australia only has one, and that's Lucapa Diamonds, who are doing a great job in exploration and mining in Angola. And this ASX market obviously has the ability to tap into the Chinese and the Far East markets, which I think will become progressively more and more important over the next decade or so. The London Stock Exchange is the second largest. It's home to 9 diamond companies, most of those operating in Africa, because that tends to be the kind of geographical split. And certainly, as I mentioned earlier, I see AIM beginning to get the winds of deregulation. That certainly came out from a London Stock Exchange presentation given at the Cape Town Mining Indaba 6 weeks ago or thereabouts. And then from a London, Johannesburg and Botswana Stock Exchange perspective, I mentioned earlier there are no diamond listings on the JSE. There are 3 secondary listings on the Botswana Stock Exchange. I've mentioned 12J's not working. And sadly, there's no local incentivization in Botswana, which is quite interesting, seeing that a vast majority of their GDP is based on diamonds. In 40 years, according to my colleagues and friends' estimates, there may not be any diamonds in Botswana. So where is the local incentivization to citizens who have made money to invest in junior diamond exploration in Botswana? And this is an ongoing discussion and an ongoing debate we have with the authorities in Botswana. Mining incubators are generally actually where you actually start to get your money from. I've already given you an example of the 162 group, which is a mixture of entrepreneurial skills, business experience, risk appetite, and selecting management teams. But you've got two fantastic examples in Canada, being the Hunter Dickinson group and the Lundin group, which do exactly the same kind of thing. So this is actually the kind of the birthplace, the traditional birthplace for juniors and developers. But there are quite a few new kind of companies which are merging into this space, chiefly because of the difficulty of raising money for junior company financing, because of the regulation surrounding it, because it's a highly specialized area to differentiate between different diamond explorers. These different companies here use a combination of the business incubation approach, financing through crowdfunding, venture capital, cryptocurrencies, a blended approach to try and fill that gap that we need. We know we have to do exploration. We know there's difficulty in raising money on the public markets, and there's a home for that money. How do you bridge those together? And these are some of the firms which are beginning to look at this gap, and this is probably an area of great growth going into the future. So, ladies and gentlemen, what is my conclusion here? Well, clearly, without exploration, there'll be no future mines. That's an absolute truism. So what is required to stimulate exploration to get us out of this low but increasing point? I hopefully have demonstrated in this presentation itself that local incentivization is absolutely key and is probably one of the most important things. The Canadian market stands out as a great example for many other jurisdictions around the world. The emergence of new business incubator models to take over the role of typical venture capital financing and IPOs is becoming particularly important too as well. And this all goes without saying that you absolutely have to have security of tenure, because why would you spend a vast amount of money on exploration if you did not have that automatic conversion to a mine? And of course, political certainty. That everything is legislated and is not up to some kind of ad hoc ministerial committee. And then finally, the dual role of breakthrough technology. And this is something that we haven't seen in the diamond exploration business for some time. Many people are working from it quiet in the background, and if you went to the diamond session earlier today, you would have seen some very interesting things beginning to happen in this space. And this will basically, I think, enable exploration funding. So despite the structural change in diamond pricing, and Paul and Chaim, I'm sure will talk about that in more detail, the diamond supply gap continues to widen. Southern Africa remains a highly attractive destination from a prospectivity perspective, as well as a business risk perspective. And it has very little competition compared to a jurisdiction such as Canada. So thank you very much indeed for your time, ladies and gentlemen.
Thank you, James. Our next speaker is Mpumi Zikalala. She's with the De Beers Group out of Johannesburg, South Africa. And I got to put the glasses on. The title